This is not unique to this time period. 30-year mortgages have been around in America for a long time. If you look back in the late 70s and early 80s, when the Federal Reserve raised interest rates aggressively to bring inflation down, people also had this lock-in effect, and there was a big spread between current mortgage rates and the average mortgages families are actually paying. So that's not unique to right now. And this notion that people aren't selling, I agree with you, you're right, but those same people also aren't buying. Most people who buy a home are leaving a home. And so it takes supply out of the market, but it also takes demand out of the market. So I think that that story gets a little bit over too much attention because it affects both sides of the equation. Long term, we know that monetary policy can bring inflation down. The big question mark in my mind is how restrictive is policy right now? I would have told you, relative to the pre-pandemic, having mortgage rates where they are and having the federal funds rate as high as it is, mid-fives, that would feel like we'd be putting 2 feet on the brakes, slowing down the economy. It seems like there's more resilience in the economy than I had expected. So maybe because of some of these dynamics, these interest rates only really mean we're putting 1 foot on the brake and not 2. And so there's a lot of, the biggest uncertainty in my mind is how much downward pressure is monetary policy putting on the economy. That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.